Welcome to the Shakaama Live Show with your host, Shakaama. Do me a favor and watch the entire video. What I'm attempting to do is to present to you at the lowest common denominator, so I mean the dumbest, most dumb person possible could understand it. And this is what your newspaper is written in. Did you know that? Your newspaper has determined what grade level reading skill the average American has. If you go to Japan, Japan is of the opinion that their newspapers should educate people. So they have a stat that says that if you read a Japanese newspaper every day for 3 years, you would know all of the Chinese characters in Japanese that you would ever need in life. That's how far advanced they are. Contrarily, I was told in my YouTube training, and back in the day we had YouTube training. They still do, but now it's more about pushing a narrative. You can certainly find the YouTube training videos if you're a YouTuber because they're all unlisted, but the training now is more of pushing a narrative. But they said you want to speak in the lowest common denominator, at the lowest level, so that the most amount of people can understand you. So here's my presentation of insurance that any and everybody would understand. And I'm going to speak in generality. I want you to watch the whole entire video if possible. The needle is not moving on me being monetized on YouTube. I don't know what the problem is. But this is the most lucrative. This pays the most money on YouTube. This topic, insurance. This is probably something that your entire family, hint, hint, could watch and learn about. What is insurance? Insurance is a gamble. It's a statistical gamble, but it's a gamble. What's the gamble? The gamble is that we're going to choose a topic, a financial topic, and then we're going to gather as many people as possible, and we're hoping that none of the people ever ask for their money back. So what's the actual gamble? The actual gamble is that you have a pool, and in this pool, you're going to have people who can't possibly ever ask for them, but they're still paying monthly, quarterly, yearly into this pool. The pool is car insurance. The pool is life insurance. The pool is homeowner's insurance. The pool is homeowner's liability insurance. So what is the policy actually? So the policy says that if you drive a car and you get into an accident, because you have been paying every month or every quarter or every year into this pool, if you get into an accident, we will pay for all of the repairs on the car. Now, the details vary, right? So to limit the liability of the pool, they're going to say stuff like, we will pay all of the repairs of your car after you have covered $200 of repairs, after you have covered $500 of repairs, after you have covered $1,000 of repairs. Now, what does that do? That limits the liability of the pool. So if it's something like $200, that literally means like if you get a scratch on your paint, you are always going to cover the repair on that scratch, because there is no paint scratch that's ever going to go above $200. I'm making all of this up because I have no idea about cars. I got into a car wreck. I died, came back, and I have never driven a car since. I am scared in vehicles, and I don't leave my house other than to walk certain places. I can get into moods where if I get into a car, I have heart palpitation. And that was over 10 years ago. That was over 14 years. And I made a friend, and he was much older than me, and he had not driven a car since he was 8. He got into a wreck, tremendous wreck, right? So anything that I say about cars, I am literally guessing. I have no idea about cars. So they raised how much you have to pay to $500. Also, what this does is also reduces how much it costs for your car insurance. They raised the limit to $1,000. That reduces how much you have to pay for your insurance. But the whole idea is that there is a pool of millions of people paying this company to cover car repairs, right? Same thing with homeowners insurance. And the homeowners insurance will say, if something happens, we will pay for repairing the home, right? And then they could say stuff like, we're not going to cover fire because you live in cedar forest, redwood forest, California, and yearly they have fires. We're not going to cover. You moved there. You accept all of the responsibility if your house catches on fire there because fires happen there. We're not going to cover floods in Corpus Christi, Texas, because floods happen there every year. We're not going to cover hurricanes in Louisiana because hurricanes happen there every year, right? Because you have this, then you pay very little on your homeowner's insurance. But the idea is that there are millions of people paying into this pool of homeowners insurance. Everybody got that, right? Now, you said, well, what about life insurance? That seems crazy. Yeah. Life insurance says you're going to die. Nobody gets out free, right? But what you're doing is you're going to give us money, and millions and millions and millions of you are going to give us money. We're going to take this money and we're going to invest it. And we're the insurance company, and we have super duper experts who do nothing but look at the statistical data to show this is the best way to invest the money for our life insurance policies. And we are going to make money off of you. And we hope that you live till you are 120 years old because you're going to be paying this for the whole time. And then when you die, we're going to pay out to whoever you said we need to pay out, right? So the idea is that A, you live long. B, they're going to be investing in that money for the whole time that you're paying it. And so they're hoping to make millions of dollars off of it. And then when they pay out, they pay out. Hopefully they come out ahead and the pool comes out ahead. The whole idea is that the pool comes out ahead. Kind of crazy when we're talking about life insurance because nobody gets out alive. So that means that the pool gets out ahead because they are fantastic investors. Well, there's a new trick to the game. Using insurance as an investment vehicle, right? The insurance company invests all of your money, car insurance, homeowner's insurance. What else is that? Homeowner's liability insurance. That is, I have bought a house. I didn't have enough money to pay for enough money so that the bank wouldn't be nervous about lending me the mortgage on the house. So I have to pay insurance on the house until such time as I accumulate enough money to pay into the insurance. So this is an extended fund that you pay into to cover your down payment on the house. And the whole idea is that you are prorating your down payment so that the bank can be then not nervous about having lent you a mortgage for 15 years, 30 years, right? And then after you have paid enough into cover the down payment, you can then say, okay, I have paid enough into the down payment. So now take away that insurance. But this is all escaping me right now. I have high blood pressure and I had a big scare and I took my medication and I'm doing better, but I'm probably not of sound mind right now. So stuff is escaping my brain. Yeah, that's the word for it. Okay, so that covers the homeowner's liability. You got that? You prorated the home. Okay, so the idea is that you are going to stay in the home. You are making money. You are going to pay off your mortgage. You are not going to go anywhere. The bank was nervous at first. You paid into this insurance to prorate your down payment. You have now prorated your down payment. And the pool is millions of people, or the insurance companies is saying millions of people are paying in this pool to prorate their down payment for their home. And we'll take the risk, not the bank, that you will stay in the home and keep paying month after month, year after year. And so then eventually you'll pay off the home and everything will be hunky. But make sure that you go back and refinance everything once you have paid out the amount for the down payment, because otherwise you're just giving money away, right? because you paid off the down payment. The whole idea was that the insurance is for the down payment, and the risk is that you could skip town and not pay and leave everybody hanging. But that's the insurance part of it, right? Investing. There's now vehicles for investing, and then you have stuff like reverse mortgages where they give you all of the money for the value of your house, and I believe you pay retroactive. I believe you have to own the house, and you pay retroactively a mortgage on a house that you should have already owned. But the idea is that you get all of this money, put it in the bank, and then you live off of the interest in the bank. So we're talking about maybe you have a $500,000 home. So they give you $500,000, you put it in the bank, and then you live off of the interest as a part of your retirement plan. I am not certain on that. So if you want to correct me on that, you are welcome to do that. I was very skeptical about the reverse mortgage at first, and I apologize if I am completely out in left field. Like I said, I've taken medication a couple hours ago. I was having some very, very bad symptoms like pain in my left arm, pain in my left side of my face. I had not taken my medication, so I took my medication. So there you have it. There's I shouldn't be saying this because that may be violating my HIPAA, your HIPAA, everybody's HIPAA. But I believe that's how the reverse mortgage works. They give you the money. You've already purchased the house, but they give you the money for the house, and then you pay, and hopefully you can live off of the $500,000 or $1 million. Maybe your house is worth $1 million now. You bought it and it cost $10,000, but now today it's worth $1 million. You put that $1 million into the bank, and the interest you live off of, and you also then pay a mortgage to the insurance company that gave you the $1 million to begin with. And it's a win-win situation for them because they are guaranteed your house because they then own the house. They bought the house from you. That's the whole idea, is that basically they bought the house from you, gave you the money. You get to live in the house, so they don't ever have to go out and find a tenant. It is a fantastic deal, right? And then you get to live off the interest of the house, and you pay them the mortgage rate every month or a quarter, right? There you go. I was very skeptical of it. It sounded like they were scamming people, and I believe some people were because there are scammers in this world. Did you know that? Okay, there is life insurance that you can invest in and use as a investment vehicle in your portfolio. If you are with a reputable insurance company, it's a no-brainer. But it's based on the reputation of the insurance. It's not based on anything else. It's not based on how much money it should be age of the insurance company, reputation of the insurance company, reputation. So better beers, any complaints, you got to read the complaints about the insurance company and how much money they control. That's the idea, that they control. So if they control $1 trillion in insurance, they are less likely to scam you if you do one of the investments. But the whole idea is the pool. The whole idea, you can open up an insurance company. If you have a really big family, that would be a great way to save money, right? You get your cousin who's fantastic at investing, and I mean fantastic, because the whole idea is that send the money to the insurance company invests it, and they pick and choose the very best candidates to go into the pool of insurance. So, for instance, car insurance. Car insurance for men is super duper expensive, especially when they're younger. As you get older, the insurance premiums are reduced. But here's a huge factor. If a man has a child, Monday, no child, Tuesday, child, your insurance premiums drop dramatically. Why? Because men take on the responsibility of children and it changes their life. This whole idea that men don't want to commit and all of this political stuff, all you have to do is look at insurance companies. And I'm serious about everything with you can have your insurance company pick your wife. How about that one? The insurance company has actuaries. These are people who look at statistical data for human beings, and they can say, we know that this person, we pulled up their file, we know that this person loves dogs. They would rescue a cat out of a tree. They would run into a burning building to save children. They are a fantastic driver. They're super safe at the pool and watch out for children. They walk old ladies across the street. They would never go back on their word. How about that one? They would never lie. They would always pay any loan, even if it was a person-to-person loan from their friends or family. An insurance company would know all of that stuff. You could literally go to an insurance company and pick out everything. What's a big deal? The big deal is that you could, instead of reading the news, you could go and read stuff from insurance companies to really find out what is going on. I know that's going to probably make news people mad, but statistically speaking, hands down, the insurance companies know everything. Why? Because they have to know. Because of the pool. They have to know who's a good fit in the pool. Because there's different pools. There's the people that pay $1 for car insurance. Why? Because they'll never get into it. And even if they do get into an accident, they've opted for the $10,000 down payment to fix their repairs first before calling on insurance. They can fix the car themselves. And so literally the insurance company is literally there just in case something just dramatic happens. So they charge them $1 a month or $1 a week or something crazy, because these are the best people as far as cars are concerned. Same thing with homeowners insurance. These people repair their home every year, no matter what. The home is made out of solid granite, and they polish it every year, and they coat it with that DuPont coat, and so the rain can't even penetrate the DuPont coat on the house, and so the house is going to be here for 1,000,000 years. It would take something outrageous. And they don't have fire insurance on the home, so you don't have to pay for the fire. So there you go. That's the perfect person to go into the homeowner's insurance pool. And the actuaries come in, and the actuaries say, this person is going to live until they are 99 years old. They want to take out a $5 million life insurance policy, charge them 50 cents for anything. They are going to be here forever. We are going to make so much money off of this person. It's just everybody in their family has lived to 100, 102, 105. This person has the perfect genes. Charge them almost nothing for the next 70 years. This is perfect. We've hit the golden calf right here. And they go into the super premium pool. There you go. That's insurance. That's everything that you need to know about.